Bismillahirrahmanirrahim. Subject is Advanced Corporate Finance and today topic is on long-term debt. Today we will discuss asset securitization. What is the concept of asset securitization? How the company when issue a bond, how it is what is the method to repay it? Means the bond, how the bond can be retired by the issuer. Second is what are serial bond? What by mean what are means what by mean serial bond? Call provisions. If there is any option in the bond that it will be buyback by the company during before its maturity. How we will evaluate this if these call provision is available, its price and value of the bond who having call provision. These are the topic that we will discuss in today's lecture. Moving further, asset securitization. What is asset securitization? Asset securitization is basically the process of packaging a pool of asset and then selling it interest in the pool in the form of asset backed security. For example, the company have, let's suppose, three assets, A1, A2. Let's suppose these are plants who are generating revenue, where these are stores who are generating revenue. These are, let's suppose, three assets. The company collect these three assets into one pool. Let's suppose its price become 1 million US dollar. After pooling it, then they issued any securities the company issue securities, financial securities, which is backed by these assets. Means the value of these assets are pooled in one form of pooled together, and then the company issues financial securities such as bond, etc. Against these assets, and it is told to the bond holder or to the debenture holder or to any security holder, a certificate holder, that their security is issued or their certificate or their bond is secured by these pool of assets. What is asset-backed securities? Asset-backed securities is basically debt securities whose interest and principal payment are provided by the cash flow coming from this discrete pool of assets. What have been insured to the certificate holder? That its principal amount and its interest. Let's suppose that is interest and that is principal amount. Both will be paid from the cash flow generated by this pool of assets. I mean, these assets, let's suppose plant, or these are retail store, or these are such type of asset who have a capability to generate cash flow. So the bondholder will be said that your security have been backed by these issue, by these assets, and your interest and the principal amount will be paid cash flow coming from these assets. What is the purpose of this asset securitization? First of all, to reduce financing cost, because when any asset is backed by security, then it is called less risky asset. So the investor or the people who are going to invest in such type of asset will demand less interest, less required rate of return, or less risk rate on these investment because it is secure financing. So overall cost of financing decreases. Firm pick assets to package and use the cash flow. Let's suppose if these assets are, this is basically matching concepts. Let's suppose this asset useful life is estimated as, let's suppose, how much years? Let's suppose 15 years. And when this securitization is done, these securities are also issued for 15 years. So the cash flow coming from these assets will be used in these to service these debt burden or to service these securities. Asset removed from the balance sheet and sold to an entity. Bankruptcy removed entity means the entity which have no probability or very less possibility to be being, which is called special purpose vehicle. So these assets are then removed from the balance sheet. There is another small firm who are specialized in these things, and they are basically spin off to this small firm which is called special purpose vehicle. So this special purpose vehicle is responsible to operate these assets. SPV raises money by selling asset-based security. What this SPV is doing? SPV is basically just sell the security of the company. Their sole purpose is to sell securities and then generate cash from it. SPV raises money by selling asset-based security. So that is the purpose of SPV, is just to sell the security that are backed by these assets. Retirement of bond. How the company will buy back its bond and pay the principal amount to the bondholder. There are multiple methods how to retire a bond. First is sinking fund. Fund established to periodically retire the portion of securities issued before the maturity. Periodically means not all of a sudden, but certain bond on one date, certain on another, in some amount of the bond are buyback on the third and the fourth. So periodically the company retired or paying back these securities, debt securities issued by the company. The corporation is required to make periodic sinking fund payment to the trustee. As I told in earlier lecture on long-term debt, that the bank basically appoint any trustee. That is, let's suppose, that is corporation. Corporation issuing a bond must have a trustee, and these are the bond investors who have a bond or who will buy a bond. So these trustees basically are representative of these investors who are investing in a bond or fixed income securities. So organizations, if have a sinking fund, should make periodic payment to this trustee, and the trustee will then call back these bond. By calling back means they will pay the money to the bondholder, and bondholder give back them certificate. There are two forms of sinking fund retirement of the bond. First, the corporation will do. The corporation make cash payment to the trustee, which call the bond. Means this is corporation who issued a bond 10 years earlier. Now he is calling back. He may pay to this trustee, or the trustee means that is one organization in between the investors of bondholder and the organization. When the corporation pay a cash to trustee, which will call the bond back. The corporation purchases bonds in open market and deliver them to the trustee. Second method is that a corporation itself, let's suppose there is a corporation or a company who directly buy the bond from open market on sinking fund, and then these bonds are give back to the trustee. When bonds are called for redemption, the bondholder will receive a sinking fund call price. When organizations basically called that you should have give back us the bond issued by the company. Suppose this is a bond and it is in holder hand. Now it's been buyback to buyback. Now we want to the organization call the bond and the bondholder give back this bond to the company. And what the bondholder will receive? The bondholder will receive sinking fund call price. Means they will be paid a call price from sinking fund. So sinking fund is basically what when organization periodically apportion some money from their earnings in order to buy back the bond. The bond are called upon. Not all bond means one quantity of the bond, then how they will determine that which bond should be called first. So it is on a lottery basis. The published in periodicals like Wall Street Journal that these are basically bond which will be called, which are called back by the company. Bond should be purchased in open market. Even the organization can purchase the open market, but he should see that the market price of the bond is how much. If it is less than the sinking fund call price, they should buy it in open market. Means if the bond have a price that is less than the price paid is a sinking fund by the company, then the company should buy this bond in a open market. Retirement of bond further. Volatility in interest rate or decline in a credit quality of the firm could lower the market price of the bond and hence value of the firm having this option. Interest rate and volatility of interest rate. Second, if the company ranking and credit quality have been decreased, two things basically discuss here. One is interest rate and other is credit quality of the issuer. If it is decreases or these are highly volatile, then price of the bond become low. Then the market price of the bond become low and enhance the value to the firm of having this option. When the market price of the bond become low, then it is very attractive for the firm to buy it from the open market. Bondholder may benefit from the orderly retirement of the debt amortization effect, which reduces a default risk of the firm and aid liquidity to the bond outstanding. What is the benefit of calling back? There are two benefits. One is it will reduce the default risk to the bondholder. Secondly, it will increase the liquidity. When the company is basically buying back or calling back, or there is a calling option in the bond, it benefits the company in two ways. First, it really increase the liquidity. Second, it decrease the retirement of debt. Retirement of debt. There are two benefit. One is, let's suppose, increase the liquidity, and second is default risk on the retirement of the debt. Balloon payment is basically when the payment on debt is much larger than other payment. That is final payment, most probably, that the organization paid to the bondholder in one sitting, that are in one installment. There is a huge amount is called balloon payment. Many bond issues are designated to have large financial payment. For example, to pay off the debt. For example, corporation may undertake 10 million bond or borrowing, 15-year bond. These are basically issued by a company in order to get a loan. Firm is obliged to make 500,000 sinking fund payment in 5th and 4th through 14th year. How much? Obligated to 500,000. Sorry, 500,000, 0.5 million each year. The final balloon payment on 15th year would be 5 million. Means the company is liable to pay small portion, and finally the bond call the company. Final balloon payment on 15th would be remaining 5 million. This is a huge payment, and the company must be prepared to maintain their liquidity. What is serial bond? Serial bond, an issue of the bond with different maturity, is distinguished from the issue with all bond having identical maturity. For example, company have a bond 1 to 20 years, but these are not same maturity. If you want to buy a 5-year maturity, they will give you. If you want to have buy 6-year maturity bond, you can purchase. If 7-year maturity, you can purchase. 10-year maturity bond, you can purchase. So these are serial bond. For example, 10 million issue of serial bond might have 500 of predetermined bond maturing each year for 20 years. 10 million issue of serial bond might have 500,000 predetermined bond maturing each year for 20 years. Maturing each year means this can be mature and can have different maturity life. So the people who are interested in different maturity life can purchase these bonds. Investors are able to choose maturity the best fits their needs. Means wider investor appeal is available in this type of bond. All provisions feature an indenture. Indenture means this is a contract between trustee and the organization that permits the issuer to purchase a security. A series of fixed price before maturity is also called call feature. Mean if in contract there is a provision that purchaser securities can repurchase, the issuer can repurchase the security at fixed price before maturity, it is called call feature. Not all bonds are callable, as we discussed, but if period of low interest rate forms more heavily to issue a non-callable bond. When there is a low interest, obviously no attraction in callable. The organization will issue full-time interest or longer time interest rate. When bond is callable, then the price is usually above the par value of the bond and often decrease over a time. Call price at which the security will call, with a call provision can purchase the issuer prior to the security. For example, the call price for the first year might equal to bond par value plus 1 year interest. But after this, the situation is quite different. According to when they can be exercised, call provision can either be immediate or deferred. Call provision provide financing flexibility for the firm's condition if the firm's condition are changed. Value of call provision as or par privileges. Callable bond value is equal to what? Non-callable bond value minus call option value. So this is the formula. Call privileges. The call privileges is valuable to the firm, the detriment of bondholder. As such, bondholder require premium for additional risk in the form of higher yield. The greater the volatility of interest, the greater the probability the firm will call the bond. This call option is more valuable, all else equal. Thank you. This is